The Reserve Bank to hike rates yesterday, but most were pretty shocked at the size of the rise. To tackle inflation, the RBA went in hard and lifted the cash rate by 0.5%, its biggest one-off interest rate rise in more than 2 decades.
Yeah, joining us now to walk us through what that means for mortgage holders and the property market itself is Lloyd from Oz Property Professionals. Lloyd, it's great to speak to you today. Thanks for coming in to explain this to us.
Good morning.
Was the RBA too aggressive?
I don't think so. I actually expected that because I think if they go in hard now, it might actually get things under control. Because if they just go with little increments, then it might take longer to get it more under control. So if they do a couple of big hikes now, maybe by the end of this year, towards next year, it might be a little bit more under control. We can see less of these hikes.
How high do you think interest rates will climb?
My predictions at the moment, probably about 2.5%. So probably 2% by the end of this year, and maybe by the middle of next year, 2.5%. And hopefully we won't see much beyond that at this stage. But of course, it does depend on what's happening in the economy and inflation and things.
And what does that mean for someone's mortgage, say the average mortgage of $600,000? If it hits that level by the end of the year, what does that work out to be in monthly payments? Yeah,
so it does tend to work out another $200, $250 a month in payments, depending on the interest rate that they're on at the moment. So, so it could affect people. It just depends on what sort of buffer they've got in place, and they might need to look at some of the other living expenses and just trying to, watch their P's and Q's a bit. Yeah.
In the Westpac, obviously, we're first out the gate with it. We expect the other three to follow. Is it too late to fix rates?
It's not really too late to fix rates. What I'd recommend, though, is that you speak with a mortgage broker rather than just going to the bank, because if you shop around with a mortgage broker, they'll actually find some banks that might be able to look after your best interests. Because remember, you can't beat the banks at their own game. So if you start fixing rates now, particularly if you're thinking, oh, let's fix it for 3 years or 5 years, the banks are going to be predicting what's going to happen. So they're in there to make money, of course.
Yeah. Now, how will all this impact the housing market and the rental market? We've kind of got dueling kind of problems here.
Yeah, that's right. So I think there's a couple of things there. There's several housing markets around the country. It's not just one. So I think in the cities, the bigger cities, particularly like Sydney and Melbourne, we're going to start to see things slow down a little bit. But I think that there'll be some of the regional markets that are a little bit cheaper, that the markets are still going to be quite strong. And we're probably going to see more investors get into those regional markets and probably less investment in the cities where it's actually going to cost you more in cash flow.
Yeah, now, it's obviously affecting an awful lot of people. A lot of people are already hand-to-mouth when it comes to stuff like this. I panic when it comes to the mortgage and kind of what I should be doing with the house, whether I need to sell it or not. I mean, you're a buyer's agent. What would your advice be to clients?
Yeah, so my advice to new clients is to actually think about whether they need to buy a home for themselves at the moment or whether they should perhaps get onto the property ladder through rent investing. So if there are people a bit unsure of what's happening at the moment, just Rentvest, which basically means you can live where you want to, where you need to work and things, but maybe buy an investment property in a good location that's got good population growth, good infrastructure, but in a cheaper area around the country. The other thing that people often don't realise is that when banks assess you for a loan, they actually have what's called an assessment rate, and that is basically 3% above what the interest rate they're actually giving you. So if you buy at 3%, they're actually assessing you at 6%. So the banks are building in that buffer. So what people might need to look at is what their other living expenses are and maybe cutting down in other areas. But I definitely don't think it's time to panic, because even if we get back up to 2.5%, that's pretty much where we were about 3 or 4 years ago.
Okay. Don't panic just yet.
That's right.
Okay, all right. Lloyd, thanks so much for coming in today.
Thanks so much.
Thank you, appreciate it. Now it's back to Ange with more Neighbours stars soon.